Greetings, everybody. This is Jeff Scott, and this is my weekend review. It is actually the 8th, still Saturday night, about 9:40. It'll be the 9th by the time I posted it, and certainly I always date it on the Sunday. I titled today, For Whom the Hindenburg Tolls. If you don't know what the Hindenburg Omen signal is, you will by the time we finish. And I also use it to pay homage to somebody who I learned a lot and have a lot to thank for, Ian Woodward, who would have been 87 this week. And I think there's some interesting thing about that number as well, because if I remember correctly, 1987 had some interesting market changes. And the reason why Ian and the Hindenburg go together is Ian, I don't think, would ever claim to have discovered or invented the Hindenburg Omen, but he certainly revitalized it. And he became an internet sensation because of his discussions about the Hindenburg Omen, which, as you see, we'll see, is something to pay attention to. So, we'll start up here, 1 second. There we go. As always, this is for educational purposes only. Anything I recommend is in the spirit of education, not investment advice. I'm a doctor, not a broker. I'm independent. No one pays me anything to say good things or bad things about anybody. And I've paid for the software I use, and trading involves risks, and you alone are solely responsible for any investment decisions you make. I do, from time to time, talk about options, probably not tonight, except perhaps some of my defensive strategies. And I just want to make sure you're aware that some folks consider options to be very risky, and I refer you to the Options Industry Council, OIC, website for some background information. I am formally announcing that I am going to do a live meeting, and I guess I should put my email address here. As you can see, the live meeting will be Wednesday, November 28th. And yes, I do say Wednesday, and you're probably thinking, what a strange day to have a meeting. I agree with you. hgsidoc@gmail.com is my email. So there's a couple of reasons why I chose that Wednesday. I still work, and there's an American Society of Hematology meeting that starts on Saturday. So the weekend was out. The weekend before that is Thanksgiving, and John Person is doing a 3-day meeting that starts on Thursday. So I'm holding it at the same place, which is the Palm Beach Gardens Hilton Garden Inn. I'll hold mine the night before, on the 28th, which is Wednesday, all day, and John will hold his on the 29th, 30th, and 1st. For those who've been to my meetings before, know that I take every penny I collect from you and I give it back in different things. Obviously, I got to pay for the place and the technology, but I spend a lot on dinner on the 27th. Typically, we go to the Capitol Grill for dinner. Breakfast and lunch will be provided during the meeting. All attendees will receive videos of this meeting as well as past sessions. All PowerPoints from the meeting as PDFs. And then I have a number of indicators that I've had done for me for TOS, TradeStation, and TC2000, which I freely share to attendees. The tuition is $500, and then a rebate of $100 will be given to anybody who either registers or decides at the meeting to stick around for John's meeting. So I'd like to have as many of my folks go to John's program as well. What will the agenda be? Well, I always start with a couple of pre-meeting webinars. Now, many of you have been to my programs before, and you don't want to go through the HGSI stuff again, the basics. Well, let me tell you, I went to 20 Ian meetings, and after about 10 of them, I said, why does he do the basics every time? And then I realized why, because that's how you get good at it. So I'll do a pre-meeting vocabulary and basics and options webinars. It'll be 2 or 3 webinars. Again, you'll get the videos for those and the PowerPoints, so that when we get to the meeting, I don't have to do the basics. I will start with HGSI 101 and go all the way to 401, 501, and 601 to giving sort of advanced understanding of some of the things behind what Ian taught us. I'll talk about how I apply it to find my A trade, which I stole that terminology from Elder, finding the type of trade I look for, how I manage the trade, stops, options, position size, stops, losses, targets, and position size. Then, do I buy options or stock, and when? And what are my favorite option strategies? Seasonality and earnings. I gave you Alta a couple weeks ago. That was a home run. Netflix earlier in the year. This past week, Palo Alto Networks was another one that I traded, but didn't want to put that one out because I thought it was higher risk. And then I'll do private webinars. When I say private, it's just the attendees of the live meeting for meeting review and Q&A. Now, we have the benefits that this live meeting is occurring during market hours. Probably that means I'll start the meeting before unofficially at 7 in the morning, so I could be doing my pre-market prep all the way up until about 9 o'clock when we'll start kicking off the regular sessions. So email me if you have interest. I won't start accepting checks until I get 10 commitments, which is the minimum for me to hold the meeting. At the meeting, you'll hear about those that influenced me and some of what I learned from each of them. I started with CanSlim, improved by Morales and Kocher. Ian Woodward, may he rest in peace. Happy birthday, Ian, up here. Really taught me how to use CanSlim practically and took it to the computer with Hgsi. Ron Brown, his partner. John Person, author, trader, software developer, money manager, and mentor to me and friend, really taught me how to take the stocks I identified on the left and how to manage them to make money. Van Tharp, money management guru, and then a couple of great traders, George Lee on the left and Cigar from Superior Profit, who's got some interesting indicators and participates on the Discord site. What do I need in my desert isle? I have a lot of programs, but I need TradeStation, Thinkorswim. Genesis is optional. HGSI and EdgeRater are great analytic tools, and I usually supplement it with some seasonality programs. Speaking of websites, this is the HGSI website. Two things here, free 30-day trial. They don't even ask for a credit card. And down here they have investing strategies. If you click on that, you'll see many videos from Morales, myself, Ron Brown, etc. Stock patterns are cyclical and broken record time. We've truncated the top. We are going running up and stalling, pulling back, stalling, running up and stalling, almost in an upwardly trending Darvas box. Now, it certainly feels to me like we have entered the red circle here of gloom and doom, and we're about to pull back. And I'll show you the evidence to support that. But every time we've done that since February, we've rebounded very quickly. So it may not be over yet. I'm going to look for other footprints and clues to help guide me. And therefore, there are a number of things that I might look at how I trade. And as I start to get more cautious, raising cash as a position, taking smaller positions, selling premium, less positions are things that I've been doing. And frankly, I've already started buying puts and contra ETFs as a hedge against my long portfolio. Friday was a strange day. I was actually up a lot. I went into a meeting from 3 to 4 and came out and was still up, but I wasn't up by much. And as you look at it, I'm just looking at the red and the green. I want to point out a couple things. Energy, weak. Financials, weak, but there's some mix. There's some green here. Berkshire, JP Morgan were green. Capital One, Morgan Stanley, American Express. Some of the regional banks mixed. Insurers were weak. Broker-dealers were mixed. All right. Technology had a tough week, period. NASDAQ was down twice what the Dow was. Staples were strong. Discretionary looked okay. Retail still okay. Utilities were almost all negative, as were REITs, home builders, and the foreign market. So what does that tell me? It tells me interest rates must have been going up. If I see banks showing strength and utilities and REITs down, home builders down, that's a sign of footprints of higher rates. If we look at the markets, Let's just go into Thinkorswim, and let's go into one chart views. The good news and the bad news. Last week I said I thought the markets were toppy. I expected a down week, but I still expected it to be higher later in the year. So this is the E-mini futures. This is going back to March. Let's try and go all the way back to the beginning of the year. So let's just look at a year's worth. So a couple of things. We hit the high of the year when I bought my boat on January 26th, red candle high on the 29th, and then a significant pullback. Since that time, we've had one run up and a pullback, 2, 3, 4, 5, 6, 7. We're now the 8th time we've run up to a new high or a new intermediate high because we haven't taken out the February highs or January highs. And then we've done a pullback and have stopped typically at that 50-day moving average-ish or at the 17. So should it surprise any of us to see us pull back somewhere between the 17 and 50 and bounce, that would be a reasonable expectation. The next support is probably going to be the 200-day moving average, which is not that much different than where the market pulled down into this in this area of congestion. So it was easy to say a week ago that we probably had a downswing. The question is, when will that downswing end? The NASDAQ pulled back harder. Now the NASDAQ is much closer to its yearly high, which is up here, which it set a couple weeks back, or a couple weeks back, 10 days back. NASDAQ has now tested at the 50. This could be a reasonable place for the NASDAQ to bounce. Or does it knife through and correct down to the 200, which will be another 500 points down and be very painful. The Dow futures, let me get the same year look. Also peaked like the S&P in January, and the same basic pattern, and we're in one of those shallow pullbacks. It's not broken yet. The VIX. Now, the VIX is the opposite of the market. The Russell. We get a full year's worth of the Russell. Looks more like the NASDAQ with a recent peak. And again, does this look like the same thing that we've seen multiple times throughout the year? The VIX is moving up, and that is counter to the markets going up. So one concern might be that the VIX is trying to break out of its range. It actually broke above the 200-day moving average, which has been a barrier. When the VIX pops, like it did here, the markets sell off. But when the VIX falls back to normal is when it's a great buying opportunity. We might be getting ready for a VIX run. And the dollar, when you look at this chart, the dollar's been in an uptrend. But frankly, over a longer period of time, in my mind, the dollar's actually been in a longer-term downtrend. So let's look at a weekly. And you could see the dollar's peaked at 103.82 back in January of this year and fell down to 89, and it's retraced, and at least the dollar futures have not recaptured consistently the 200 weekly moving average. So that's just a little bit of what I see in the markets. So is the end here, or is this just a pause before we refresh, as we've seen over and over again? Let's carry back onto my PowerPoint. On the weekly charts, there wasn't much different to tell you. That's why I didn't spend any time there. But as you look at these weekly charts, all these indexes are in uptrends, except for the VIX, which, as we already pointed out, is trying to mount a move. And then sometimes I'll look at my charts in Genesis, which has a 3 rows, a daily, weekly, and monthly, and for columns, E-minis, NASDAQs, Russell futures, NYSE, and Dow futures. And you can see on the bottom how on the longer-term charts we're still in long-term buys. On the weekly charts, we're still mostly in long-term buys, and the choppiness is confined to the daily charts. I mentioned rates must be moving higher in both the 10-year and the 30-year turned up this week. And down on the bottom, something I've had for years, break out sort of the winners and losers based upon rising rates. You'll hear a lot on CNBC about a flattening yield curve, and it's getting closer and closer to this pink line, which is the flat line, and this is the spread between the 2 and the 10. All I can tell you from this short sample as I look at it, it looks like the S&P, which is pink here, is fine until we've bottomed and start to come back up, which means the economy must go through some troubled times, and then the Fed loosens, and when they think it's time to start tightening is when the index falls. Right now, we're still on the way down, which has not seemed to hurt the index in the past. AD lines on both the small and the large stocks pulled back a little bit this week, but are still near all-time highs. And you can see here the AD line on the NYSE, along with, at the end of the week, the Russell, Dow, Qs, Spiders, and transports all pull back. And again, this week as well, TLT pulled back some. Breadth eases, but not oversold. It's supposed to say oversold, so let me fix that while we're sitting here. And what I'm looking at here is I'm looking at, on the left, stocks above the 200-day moving average and stocks above the 40-day moving average on the right, and you can see they both contracted some. And my favorite indicator here is a 3-month new high, new low ratio, and you could see it's pulled back quite a bit. Now, it doesn't give me a signal until it gets down here, but it's certainly not overbought anymore, and it's approaching oversold. The McClellan pulled back, as did the oscillators and summation index, so I don't see signals there. Buckets. Imagine if you could hit a button and then all the stocks in the S&P 1500 put their Bollinger Bands on, and you could see how many were above or below the midline of their Bollinger Bands and where they fall within their Bollinger Bands. This is neutral as you can get. Interestingly, almost 10% of the stocks are below the lower Bollinger Bands. And that's what becomes helpful. When that number gets to 20 or 25, which could be 2 bad days away from now, it almost always signifies a recovery or a bounce. Now, Hindenburg Omens. These occur, I guess the best paraphrase I heard was, imagine when the smart guys think the market's at a top, it's going to fall, and they start selling everything they have to the dumb guys, which would be the public. So you have high volumes, you have lots of new highs and new lows because there's still a lot of buying. And there's just turbulence in the market, and it's something that is fired before every major market decline, probably ever, certainly going back to the Depression. And the problem is only 1 out of 4 are meaningful. Now, typically, like we saw here in June, you get a softening in the market. This pink here just tells me that the new lows got bigger and bigger, but you don't see the black swans with every one. When you see 4 days in a row, you start to wonder. So we definitely have a signal here that says there's high risk in the market with 4 Hindis in a row. In Hgsi, we can plot them. You can go back and look at 2007 and 8, and you could see the signal and the heads up that we got. I'm not convinced it's over here, but they're clearly, I have to pay attention to the signals, and this is a concern. Market tone has gone to all neutral. We're looking at the Woody indicator here. All the indexes are yellow, and sector strength showed some life in staples, and the other one was, it's not energy, industrials. The rest of that's pretty neutral. So not seeing big sell signals across the market, but those Hindenburgs have to make me a little nervous. Now, the canaries are a bunch of one-time leaders, and I used to track them as an early warning signal of how the market itself was doing, and it looked like they were going to recover. Now, are we just in a Darvas box now heading down, a new channel, and are we going to bounce this week? Well, you know, you could have somewhat of an island reversal there if you gap up on Monday, but once again, they broke support. Eventually, that's going to turn into a rout. A week ago, I said the market was near a top. I talked about the indexes of the past. I put together my list of the best stocks in the market at this time, And the interesting thing is this was Monday. It had a huge move up on Tuesday rather. And then Wednesday it peaked. Thursday and Friday it came down, although Friday it closed higher than it opened for a green open candle. It is clearly not broken. It's still above the 8-day exponential moving average. But I'm going to have to watch this one closely. This is a warning signal. We don't have a signal yet. Know your news. Not a big week. We got Charles Evans. He's an important Fed head speaking on Friday. We got some retail sales, import-export prices, industrial production. We got jobless claims and CPI on Thursday. That matters. Petroleum on Wednesday. PPI on Wednesday. JOLTS, jobless on Tuesday. So there's a fair amount of news. We've got a Fed meeting coming soon with a rate hike coming, and that'll probably be a bigger news week. What we don't have a lot this week are earnings. It's not to say we don't have any earnings. Sonos is widely held. Looking at this, Pivotal's a recent IPO in software, Kroger's, Adobe. But that's it. Not a very busy week when it comes to earnings. Market thoughts. After a strong start on Tuesday, the market limped into the finish for the week with all major market indices down on the week. Rates rise as Fed heads talk up the economy and rates while wage pressures spook the markets on Friday. 4 Hindenburg Omens in a row might suggest that we have some significant downside ahead, but despite this, the major indices have not broken their uptrends nor major moving averages. Sunday evening begins the Jewish holidays, which likely will lead to lower volumes and higher volatility. As the saying goes, you sell on Rosh Hashanah, which is Monday, and you buy back on Yom Kippur, which starts the evening of the 18th. So I've been raising cash, taking profits, and considering additional contra ETFs and other protection, which might not be a bad idea. So let's take a look at some charts and take a look at the market. So in Hgsi, what I usually do is I go into my user group. I look for wherever Ron Brown's market analysis user groups are. I go to Major Markets Plus. I hit Warehouse. It will open up here in a second. And then I top-down view, which is T1. And this ranks things in strength. And when I see the NASDAQ, small caps, mid caps, NASDAQ 100 semis, and biotech in the lower third, I know that it was a rough week for the stocks that I follow. And it was. It was a very difficult week. Let's take a look at some of these indexes and see if we see anything different, traditional Hgsi approach and indicators. I'm going to go into this view up here, which is a little cleaner. And let's just point out the obvious here. What's changed? I mean, I've got another extension onto this line here, ran up to the highs and pulled back. So do we run all the way down here? Do we stop at the 17 and move up, which is a possibility? Do we pull back to the 50, which is in the realm of possibilities as well? Notice my weekly bongo is still green, which is bullish. And notice the Hindenburgs came in here, and back here they came in. We saw a little bit of a pullback. So this is the S&P. And you're going to see the same thing wherever I look. Dow Jones Industrials, very much a similar pattern, perhaps not as deep in the pattern as the S&P. If I look at the NASDAQ, which had been holding up nicely, has pulled back nearly on the futures to the 50, and the cash market's got a little bit ways to go. And look why is this time going to be any different than this time here and this time here and this time here. So right now I'm working on the premise that we probably move down and match that 50-day moving average. If we slice through, I've got to be concerned about something more. And then the Russell, which has of late been leading, still doing well, sitting on the 17-day. So when I look at the indices, I see indices at the top of the range. I think there's risk of a breakdown. Those Hindis bother me, but it could also just bounce from here and go higher, which is what it has been doing. If we look at the dollar, cash is king in here. Dollar was up on Friday. And again, it's all about time frame, because if I look at the dollar over, say, a monthly time frame, you could see how it's come down hard since early in January. But looking at on the daily, it looks like it's firmed up here. So dollar is showing some shorter term strength. And then volatility, we know spiked. We saw that on Thinkorswim, struggling to get over the 200 on the cash VIX. And then if we look at gold and silver, they're probably weak considering the dollar. And these things have like had a blanket over them, and every time they show their ugly heads and we start to think they're going to recover, they run into a moving average and they fall down. There's absolutely no reason to be long those unless you're really speculative about a bounce. So now I usually go down to 07. I hit the warehouse view, and you can see I have 174 industry groups. And now I'm going to rank them by force, sort of momentum. You can see I'm down to 27 to the upside. Now what's interesting is we only had 10 to the downside. REITs, utilities, mortgage finance, real estate, more utilities, insurance. Insurance is sort of the outlier because that one should be going up if interest rates are going up. So on a longer term, there's still some strength. If I look at 5-day down, not 2-day down, I see 66, and 5-day up, I see only 21. So on a longer term, intermediate term, this market's weaker. But let's take a look at sort of the pattern of what we're seeing on the 2-day up. So we'll go through some, which are earnings plays, but telecom carriers, restaurant index, tobacco, specialty retail, packaged food, food and drug stores, cable and satellite, beverages, containers. I have a word for those. The word is defensive. Defensive stocks, industry groups really came to the top this week. If I right-click on mass merchants, you'll see a couple of big earnings winners. Five Below had earnings on Thursday night that were stellar. And this is what happens in this market when you get stellar earnings. Hold on, let me turn everything on. A big buyable gap off of the 17-day moving average with a kahuna mobile breakout. Beautiful picture. If you own it, congrats. Probably too late for me to be buying it. Costco in a big run here. Certainly extended at the top of the high jump bar. Hard for me to be chasing it here, but looks great. Ollie's Bargains did not buyable gap up, but certainly has broken out here to all-time highs. I know there have been increasing estimates. It's still an expensive stock. Again, I want to buy them when they're cheaper, sitting closer to the 50. Then we get to the index. So typically every night I'll go through the top 10 groups. So we'll look at a couple tonight. Palo Alto Networks and OKTA had good earnings as well at the end of the week, and we can just take a look at them and see what they look like. You can see the buyable gap up. Palo Alto Networks also had a buyable gap up, and this is one that I looked at and did take a small play at earnings. Really a great move. Sold off on the day, but still finishes with a buyable gap. Great earnings per share growth on a stock that's turning around. ServiceNow, I like this one even more as it's not run too far away from its moving averages. Great earnings per share growth. Splunk, less excited. Red Hat. I don't like the name Red Hat. Maybe that's a bad bias. Here you can see the Hindenburg's mobile breakout, move up the moving averages. And this may be a springboard here. I'd rather not be buying them off the 200-day moving average. So that was the second group down. Third group is other consumers, and this includes some marijuana stocks. Kronos Corp. These are going to be choppy, but right now they're in stocks, although they pulled back some on Thursday and closed up a little bit on Friday. And Canopy Growth, the one that got the big funding. Stock goes IPO, and then a couple of weeks later, they get a huge investment at a much higher valuation. people really believe in the marijuana stocks, and if you believe in them, these are a couple of names that you might consider. Entertainment content, I just go down the list. So these are defensive plays. They offer a small dividend. CBS is sideways. This is on Les Mooney's being terminated, or working on that. It's got all the right footprints, mobile breakout from a squeeze, pocket pivots, and a kahuna. I look at it and I see a sideways stock. That doesn't interest me. Walt Disney, it's interesting that it's got a pullback to support at the 50, but I need some momentum, which I don't see. Discovery, same thing. I like to see some momentum, meaning a kahuna, pocket pivots, and we get there. So I can tell you that I went through a lot of stocks this weekend, and this was not a weekend of finding a lot of great setups. Found some, and we'll look at them in a couple minutes. Telecom carriers, they usually suffer in a raising rate environment. GTT is in a downtrend, has to get above the 50, so I didn't look at this. CenturyLink is one that came out on earnings and said they're going to be able to support their very high dividend. As long as they can support their dividend, this is probably a sideways at worst stock. Not that exciting here. Intelsat, I'd have to do some research. I don't like the earnings per share growth. But here's a stock that broke out here. And this is what you want to find, coming out of a moving average squeeze and then big uptrend. And I like to find it when it pulls back to support. I've got a kahuna, a squeeze, and I'm going to put Intelsat on my buy watch list so I can dive deeper into it on my own time and determine whether or not it's a stock that I want to be in. It has a pattern that I've made money in over and over and over again. And let me just point one thing out about this pattern. This is not a put your money in pattern and forget about it. This stock is going to make a move in the next day, 2 or 3 days. If it doesn't move up off that 50 in the next 2 or 3 days, then I'm going to close off the trade because it could just as easily break down. And sometimes I stay in these things for too long and they end up going against me. So I've learned to put somewhat of a time stop on these as well. Consumer electronics, the first couple fairly well. Roku had a pullback earlier in the week when there was concern that Amazon, or last week, might be getting into their streaming business with live content advertiser supported. This is still one of the best looking stocks of the year. You could look at it as a cup and a handle and a breakout. Pocket pivots, doesn't make money yet, which could be a concern someday. At its all-time highs, still looks good, but we're going in a tough part of the market and growth has been punished. Turtle Beach is what happens when you get really punished. It had decent earnings, sold off hard. It's now consolidating below the 50. It actually, H8 candles turned this week and it's got some earnings coming in, so we'll be seeing what happens there. And Control 4, which I guess is this current competitor of Crestron, a pullback here. I'd like to see some momentum come in. I don't know about you, but I'm looking for the typicals. I don't see the semiconductor manufacturers, the memory stocks, the big banks, the regional banks, the Visa, MasterCard. They didn't make the cut this week. Restaurants, this is clearly a defensive story. And we'll look at a couple of them. Starbucks, which is working its way back up after abysmal earnings. It's passed for right now. Brinker looks more interesting. A couple of pocket pivots here, kahunas here, mobile breakout from a squeeze, breaking above the 50, doesn't have any earnings per share growth, pays a 3.2% dividend. This might be one to play, definitely a defensive play. Texas Roadhouse is already broken up. Wendy's is a potential takeover. There's some rumors about it and a couple others, whether they're taken over or acquisition. Kind of choppy. And then CMG, where I've made good money buying it off the 50. I just need to see momentum, not just that it's at the 50. So I typically go through the top 10. Number 8, I'm not even going to look at because I can't buy tobacco stocks. Big dividends, definitely defensive. I'm not cancer doc, that's why. Generic pharmas, I actually found a couple I like that are not on this list. Discerna, I'd have to understand a lot what happened here, but perhaps bouncing after bad earnings, a couple of viable gap ups, a kahuna, Fundamentals look horrible. I probably wouldn't be playing with this one unless there was a reason. Lynette's been beaten up this year. They lost one of the products that they distribute. And nothing else to really talk about there. And then the 10th group was other specialty retailers. And this is one that was a great one for me this week. Last week, I kept some calls and they ran up. Big move on earnings. But the other thing is just go back to my video of 2 weeks ago. I gave this one to you in a wrapper. I told you what options to buy, and I also showed you the seasonality, and it's lived up to its seasonality. GameStop is an acquisition candidate, had earnings. Michaels Corp, no. Barnes & Nobles, I couldn't. Funko, don't know what they do, love the chart. This is a great chart. My chart of the year, or my stock pick of the year, of ones that I actually told people about or presented live, was Tandem, which looks the same pattern, just a little bit higher. Hard not to love those things, especially when you buy them down here. So that was, I believe, the top 10 groups. And if you can't tell from my enthusiasm, this is not a week. I don't have a long list of longs. Now, what I supplement that with, and if you look inside the smart groups and you look at my name, are a series of stock lists that include things such as 3 times big volume. So these would be stocks that had big volume. Well, OQTA 5 below, we saw that already. I like pullback to the 50 with a kahuna. We've got Treasuries, Kinder Morgan, Smith & Nephew, Zix Corp. Let's look at a couple of these and see if any of them look interesting. By definition, they have to be in an uptrend, have pulled back within 1% of the 50-day moving average, and have a kahuna. This is where scanning's fun. So, I wouldn't say much of an uptrend. It's certainly at the 50, had a pocket pivot and a kahuna. ExxonMobil's got some earnings per share growth, pays a 4% dividend. Expedia, certainly in an uptrend, sitting on the 50, pocket pivot, kahuna, feels more like it's going down than going up. Madison Square Group, uptrend sideways within 1%. This one looks interesting, pays no dividend. Kinder Morgan and MLP, uptrend sideways at the 50, kahuna, pays a 4.5% dividend. Let's see if any of these really look buyable. So far, I would say they don't. Sometimes you find them this pattern, sometimes you don't. I also like over here squeezing potential SCR reversal to the upside. And let's look at Prestige Brand Holdings. So you have to be in a squeeze, which means you're probably going sideways. You have to be within a small amount of the PSAR dot. And why? Because I want to find stocks before they break out. And then I see it had a kahuna. This is actually an interesting little pattern. Mobile breakout from a squeeze, near a PSAR reversal with a kahuna. Don't love the earnings per share growth, but it does make money. Prestige Brand Holdings. So I use scans to find the stocks. So I did my typical review this week. And when I say typical, I go through MarketSmith, IBD, and a bunch of other programs, including Hgsi, where I establish a large number of watch lists. And from those watch lists, I extract the stocks and I put them in the consolidated buys category and I manually look at them. This week there were about 600. Some weeks I can't include all the ones that are buys, and some weeks I have to stretch to find any that are buys. This is a stretch week, folks. It was not a lot of things ready to break out that look super strong. We looked at Alta, Exxon, Roku before. We'll go through a couple of these and then we'll say goodnight. Pfizer, run up, pull back sideways, wants to break out again. Fundamentals probably not supportive, although it does pay a 3% dividend. John Deere going sideways, a couple of pocket pivots, a Kahuna and Mobo breakout. This might be interesting. I'd be looking for this to break out, keeping in mind it's probably one of those that gets pulled down by the quagmire with China. Zscaler, IPO, uptrend, pullback to support with the Kahuna. This is one that I think looks buyable here. Cigna, uptrend, pullback to the 50 Kahuna. Lots of M&A activity in their space. ServiceNow we looked at already. Cleveland Cliffs. I thought it was going somewhere from this breakout. All it was a high tight flag pulling back to the 50, now breaking out. Mobile breakup from a squeeze and a Kahuna. I think this thing goes higher. The fundamentals will support it. Anthem, a great stock, an insurance company, very tight, new highs. I don't see a buy point there. I just want to track it. Tesaro, a beaten up pharma that's starting to move up. Owens Corning, a beaten up construction material defensive stock that's fallen from 96 down to 57, going sideways with pocket pivots. Kahuna Mobile breakout from a squeeze makes money, much more than its multiple. These are the kind of things I like to look at, and I play some of these tight stops. Supernus Pharma is one that broke down, stopped at the 200. Looks like it's getting ready to move again. Caterpillar, similar to Deere, probably at risk with China. Geron Corp, I talked about it 2 weeks ago again. This is a small biotech that I'm in. I would love to see it clear this number here. It's getting very close. Intelsat we looked at before. Talk about the pullback to the 50 and an uptrend with a Kahuna chart. This one is the poster child, although it would have been nice to have run up and gone sideways. Copart's just one of the leaders right now. It's on the melt-up index that I just did, lower left, upper right. I put this there to hope that someday I'm going to get a pullback that I can get into it. Number of transportation stocks looked interesting. Last week it was ODFL. Here's one that's certainly in a downtrend, breaking above the 50. Not ready to pull the trigger on this one, but one I'm watching. Don't know anything about USA Technologies, but pull back to the 50 with a Kahuna. Here's a generic house. I think they make EpiPens. Pull back. This one looks like it wants to run higher. Look at its earnings per share growth compared to its multiple. Everybody knows who they are. Owings Minor. Here's another of these sideways stocks that's starting to stir. Old Republic. This was an insurance company. The reason why I got interested, they ultimately will benefit for rising rates. They've got great earnings per share growth coming in, pay a 3.4% dividend. Ecopetrol, it's kind of boring right now, but it's an energy stock that I've been long for quite some time, and I love the earnings per share growth, and it pays a small dividend. Chegg is I think a Chinese internet play. No, I'm not going to buy it here. But if we had a swish in the market and it opened up at 28 or 27, I'd probably load up the farm. And that's why I have these on my buy watch list, so I know what for if the market changes. JB Hunt probably looks better than the prior Swift, Night Swift, and that it's pulled back to the 50. Uptrend, pull back to support. I'd like to see some momentum. T2 Biosystems, this is a bottom fisher, but it's moving off the 50 with the Kahuna. Party City Holdings, kind of a sideways stock. I don't find it that exciting. Let's go down TradeStation. MFA International, another sideways player with a Kahuna out of a squeeze. Good earnings per share growth. Pays a huge dividend. You always wonder about these stocks, but if you're looking for a dividend play, 10%. Let's see if there's anything interesting here. There really is not. Here's a 13% interest payer or dividend payer in the communication world. 12% mortgage finance. 13%. So there are some stocks out there that pay some pretty big dividends. Here was a pattern I like. Nutrien, it's an IPO. I think it's in the fertilizer world. Ran up, sitting on the 50, just needs some momentum. And Packard Trucks trying to emerge from a downtrend. I don't see a lot that I would tell you to go out and buy. I think Alta's already had its run. Deere and Cat look interesting. They're defensive, but it depends on what happens with China. ServiceNow has had a great run, as has Roku. I look at this, I see a danger list. So I just want to talk for a second about what might I do or you do to protect yourself for a market fall. The first thing is to remember that cash is a position, and that the people who did the best in 2009 were people who exited the depression, recession, whatever it was, and still had money left to invest. So don't lose your nest egg. This is a risky and difficult market, and the last time I checked, even though the stock markets have been going down over the last couple of weeks, King Dollar has been going up or has been steady. So the owning dollars is not a bad thing. What did I do? I looked at the market, and hopefully I lose money on every one of these trades, which means the market goes up because I'm over long than I am short. I shorted spiders. Cheap puts. I bought puts on spiders at 287. Let's look at, and that's about where the spiders are. I had a bear call spread, which I already covered and made money on. And when I buy puts on the spiders, I buy a lot of puts. I think I've got 200 puts on the SPY right now. The SPY closed at 287.60. So I'm positioned for it to drop. So if the markets pull back, I'll make money on the spiders. Now, what about the Dow? There's an inverse ETF called DXG. I think it's called DXG. My bad, it's called DXD. I had to go look at my portfolio. This is a way I play short Dows. Ultra short DXD. So if the Dow trades up, this is going to go up. Again, it's in a long-term downtrend. These are not investments, they're quick trades. What if I think Amazon is going to fall? I have a big Amazon position. So I can tell you exactly what I did on Amazon. Amazon, I sold calls up here on every share I have. So starting at about 2050 all the way up to 2200. Those generate an amazing amount of money considering how out of the money they are. I then decided that this makes up a big component of the Qs. So I bought a 3X ETF that will go up if the Qs go down. And you can see there was huge volume on this weekend, 20 million versus 15 million normal. So I bought contra ETFs against the Dow, contra ETFs against the Qs. I've done puts on the spiders. And then the other thing I bought, and I bought options on these, not necessarily the main thing, is the UVXY, which charting is not going to teach you anything, but this is a play against volatility, and I've got long some 8.5s on this, looking for a move up to 11 or 12. And again, these are cheap, and I buy a crap load of them, and this is my insurance. So if the market opens up on Monday and it's up 1%, I'm going to underperform because I'm going to have to be bailing on these short positions. If the market opens down 1,000 points, I'll lose money, so will you. I'll lose less than I would have lost because that UVXY, the DXD, the SQQQ, and the SPY puts will be worth a lot of money. So I buy those things to dampen any drop in the market. But I do remember cash is a position, and I've been raising cash for a while. I've sold calls against most of my long positions. So on that note, I'm going to say goodnight. I want to just remind you, I do have my live meeting Wednesday, November 28th. You need to let me know sometime in the next week so I can commit. hgsidoc@gmail. $500. I guarantee you'll get more than $500 worth of value. I give out free indicators. I give out videos, PDFs. I take you out to a dinner. And if you stick around for John's meeting or you've already registered, I'll give you back $100. So on that note, I'm going to say goodnight. Everybody have a great rest of the weekend. And Happy New Year to my Jewish brethren. Goodbye, everybody.